George Parker from the finance faculty and representing today the Entrepreneurial Center. Nice to have everybody here. We are fortunate today to have three wonderful panelists, and I am simply the moderator, so my remarks will be minimal at most. But I do want to introduce all three of them, and they're basically going to introduce themselves with a little bit more of a description of what they do in their own words. But the first on my left is Patrick Gordon, who is one of our own, MBA 91, one of the really great classes at the Stanford Business School.
A good vintage.
Best class between 90 and 92, without any question. Patrick is with a company called Venture Debt, or Leader Venture. Excuse me. Venture Debt is their product, and Leader Venture is their name. To his left is Jeanne Montague, who is she calls herself here a debt broker, although she has an investment bank with her own name on it. Is that right? Montague Partners, or right. Montague
Partners.
Montague Partners. And as I say, she calls herself a debt broker. So whereas Patrick is more of a principal, Jeanne is more of an agent in the process of lending to entrepreneurs. And finally, Greg Hittleman, who is with CIT, which engages in small business lending, not necessarily in every instance entrepreneur lending, but all entrepreneurs typically are small in the beginning, and you're also involved with businesses that continue small, I guess.
Correct.
Yeah,
correct.
Okay. I might say that when I was asked if I would moderate this panel, I said to Linda Wells, who asked me to do it on behalf of Irv and Chuck, who are the faculty directors of the Entrepreneur Center, I thought in some ways debt and entrepreneurship were not all that well coordinated, because, as you know, I teach finance, and I'm well aware that most borrowers most lenders rent money, and they rent it as lenders for an interest rate, and they don't like to be thought of necessarily as investors. They are lenders. Lenders are one source of money, investors are another. And most entrepreneurs are too small and too untested to attract a whole lot of lenders. But, of course, they attract investors all the time who have a higher risk appetite. Now, of course, what complicates that and what muddies the water is that much of the debt that goes into entrepreneurial ventures is debt that is accompanied by what we call equity kickers, or participation in the upside, which makes the lenders who package their product in that form — I'm sure people have comments on what I'm saying here — makes the lenders who package their product in that form be something of a hybrid between pure lenders and investors. And my guess is that most of what we're going to hear about today is lending to entrepreneurs with upside participation. In many investment banks, that kind of lending is actually handled by the people who specialize in equities, convertible debt, debt with lots of warrants, and so forth. So it's interesting in your own mind how you want to classify that kind of debt financing. I do know that many entrepreneurs have a much different assessment of their own risk than lenders do, because lenders have been there, done that, and they've watched companies fail. Many entrepreneurs have never been with a company that failed, so they may have a little different definition of the risk profile of what goes on. The other thing is, many entrepreneurs, when you talk about the risk, are talking about themselves, and they perceive themselves as quite competent, and that can change the risk assessment somewhat. In any event, I'm just going to start out by asking perhaps on my left, start with Patrick, and have Patrick tell us a little bit what you do and what sorts of loans you specialize in, what criteria for these loans look like, what the terms are, how do you protect yourself, those things.
Certainly. Thank you, George. Thank you, everyone, for coming. Delighted to come here. When I was in the other side of the table, I had no idea what venture debt was. And in fact, in 91, there wasn't a lot of venture debt. And now it's become much more common, as at least one person in the audience I recognize can attest to. Let me describe venture debt briefly, and then I'll tell you a bit about Leader Ventures. Venture debt can be thought of in a couple of ways. The first is it's a combination of equity and debt, as George referred to. So when you think of venture debt, ourselves and other folks similar look to finance or invest in companies, and we generally do call it a financing or an investment, in a way that combines a loan but has equity upside as well. And in fact, over half, and in our last fund, 75% of our return came from the equity, not from the debt itself. So the first way to think of it is always blended, and we have never made an investment that doesn't have an equity component to it beforehand. The second way to think about it is primarily to venture-backed startups, and we can break that down. Venture-backed meaning most of what we do is in companies that already have institutional venture backing. And in fact, it's usually with a limited number of investors that we've partnered with over the years. And in most, though not all cases, we will not invest in a company unless it already has institutional venture backing. Now, certainly we and others are active with earlier stage companies, but again, that usually is either with entrepreneurs who've been successful before or companies that have attracted angel financing. So there, the second definition is backed by venture capital firms. And then the third thing that comes out of that, it is generally in what you would call technology-based companies. So that would include information technology or life sciences. And those three definitions, if you will, are the majority of what we do and what most venture debt firms do. Now, for ourselves, we are investing out of a fund that is a $300 million fund. We will invest in about 100 companies. Started investing in 2005 in the current fund. And it is, in essence, the sixth fund. Our previous funds were under the name of Dominion Ventures, which I think was the name Linda used when she first sent out the email. And the most recent Dominion fund was a 99 fund. We invested $180 million into 90 companies. And variety of industries, both in the current fund and in the previous one.
Small loans.
Really? Correct. So as you can do the math, in our previous fund, it was about $2 million plus per investment. In the current one, it's averaging about $4 million. The range is as little as 1.25 is the smallest we've done. The largest that we've looked at is $15 million.
Who are your limiteds?
So we have a variety of limiteds similar to what a venture equity firm would. High net worth individuals, family offices, some financial funds.
Mostly taxable investors.
It's a mix. Some are taxable, some are not taxable.
We're going to have lots of time for interaction, which I realize here is the point and so forth, but that gives us a little flavor for what Patrick does. How about Jeanne? Can you?
Well, thank you, George. Yeah. Appreciate the invitation to be here and be on the other side of the fence as I talk about it, since I work with companies all day. Patrick, in fact, and I met many years ago when you were just had your search fund and were looking for debt financing to buy some companies. I own an investment bank headquartered up in San Francisco. It's called Montague Partners, and we're an NASD broker-dealer, and we focus on two principal services to our client base. The first is classical mergers and acquisitions, either representing companies for sale or helping people buy companies. And the second is private placements of debt or equity capital. And as an investment banker, we're essentially an intermediary. So we've got a client, and what we're doing is trying to deliver a service to that client, and specifically with regards to private placements, which is the topic of today's conversation, is we try and identify the best source of capital for that particular client's needs. And that we look at the whole right-hand side of the balance sheet. So we're able to look at, can that client use some senior debt, classical financing from a commercial bank, whether it be cash flow or asset-based lending. We look at subordinated debt, which is similar to Leader Ventures, which is unsecured mezzanine debt, which consists of a coupon plus an equity upside. Or does that company need equity capital to get to where they are? So as that intermediary, we're trying to blend and find the best combination of financing for that particular situation. Now, I'm going to always start with senior debt, which is commercial bank debt. That's your cheapest source of debt. That'll give you your lowest blended cost of capital. Depending upon what the company is doing, what stage in the life of the company they are, then you may need to look at sub-debt and or equity capital to bridge that gap. We work with a wide variety of different types of lenders. I can't even tell you how many lenders there are out there, but for every Leader Ventures, there's a couple of groups that specialize in venture lending. There's a lot of players that specialize in pure unsecured sub-debt lending. I'm out in the marketplace right now raising $6 million of expansion capital for a company that wants to open a manufacturing facility in China. So I looked at a universe of about 80 subordinated debt funds, and we've narrowed it down to about 40 different funds that have an interest in global activity. There's some funds that, because of their backing, if they're an SBIC company, they'll only want to be able to lend to domestic entities. But we've got 40 funds. We'll go out on behalf of that client to 40 funds to try to get the most competitive term sheet for our client in terms of, and I always advise clients, you want to look at a combination of not only the amount of capital that debt source or that capital source is bringing to you, as well as the price. You don't want to necessarily go for the cheapest source, because maybe the amount of capital or the flexibility of that capital that they're bringing might be better for you in the long run, so it might be worth paying a slightly higher price, giving a slightly higher equity upside to that lender in return for them supporting whatever your project is.
Great. Thank you, Jeannie. What's a typical charge for placement? I mean, straight debt financing is cheaper than debt with an equity kicker and so forth. What's the range?
The range, it actually hasn't changed in the 20 years that I've been doing it. Typically, people charge 1% for a senior debt placement, 1% meaning for if you're going to raise.
Montague charges that.
That's what we charge.
Yeah, right.
That's what most people out there charge.
Do, yeah.
3% to raise subordinated debt, and anywhere from 5 to 6% to raise equity.
And all of that comes from the borrower, not from the lender. The lender pays you no finder's fee for.
Lenders will pay finder's fees, so you've got to be very careful. If you're going to hire an investment banker, though, you're paying that investment banker. They don't double dip. They don't get the fee from the lender.
Never happens.
It better not. I would hope it doesn't. You make certain that it doesn't. But the investment banker, if you're paying your investment banker, yes, they do not take a fee on the other side. I'm always client retained. The banks that I'm working for know I'm client retained. And, and some fast math will tell you, that fee could get to be a pretty significant amount. What you want your investment banker or your intermediary to do for you, though, is to find you a better package than you yourself can find by going out and calling on 40 people yourself.
Meaning to earn it.
To earn it.
Yeah,
you want to make them earn it.
Sure.
And then did I mention, equity capital is 5 to 6%.
5 to 6,
right.
Yeah. Okay, and next is Greg. Yeah.
Hi, everybody. Well, I do something quite different than these two people on my right. I'm with a direct lender, and we're CIT. We're the largest SBA lender in the nation. And we lend money to people who want to acquire businesses, business expansion, they want to acquire real estate, they want to acquire for their business franchises. We do that type of lending, and we're a direct lender, so we actually put the money up. What the SBA does for us, though, is they'll guarantee our loans up to 75%. So in other words, if somebody wants to buy a business, and all business acquisitions are 10-year loans, okay, 120 months is how we look at that. We will actually do all the underwriting, we will fund the loan, and then at the very end we'll go to the SBA, Small Business Administration, and tell them this is what we've got. We'll give them a checklist. They'll sign off on the checklist. They'll guarantee our loan to 75%, and that's it. We're done and running with that loan. Okay, and we retain that on our books.
What if a loan defaults 25%? Does it all come out of you first?
Yes, it does. And the part that I said where the checklist does go to the SBA, regardless, if we've done something wrong in the underwriting, we will definitely take back that loan, and that will go on our books as a bad debt. Absolutely. We have two programs at CIT for SBA lending. One is called the 7A. Okay, and the 7A is up to $2 million, okay? That's for mostly business acquisitions. It can be for real estate. It can be to purchase a franchise. It can be for a startup. Mostly what we love to do is the professionals, lawyers, medical, dental practices are probably our expertise in startups, business expansions and whatnot, refinancing debt, and so on and so forth. For real estate, we usually put that on what's called a 504 loan. Now, in a 504 loan, we as CIT will do a conventional loan, meaning we will lend all the money without SBA's help. What we require at that point is for a community development company to come in and help us out. We'll do 50% of the loan, and they'll do 40% of the loan, and they will do 100% financing through SBA. So we'll have two combined loans. And that's how we get above the $2 million 7A loan. Enables us to go up to $4 million to $5 million on real estate.
I'm sure not everybody here is all that familiar with the SBA, but it is a huge source of credit, mostly for ongoing businesses, but for a few entrepreneurs, right?
Oh, absolutely.
What percentage of your loans would you say were to entrepreneurs, defining an entrepreneur as that's the first loan that borrower's ever taken?
Right. I mean, that can be anybody. It's what we call a startup. That's our category as far as entrepreneur is concerned. But what we expect to see is that you have a very good business plan drawn up as to exactly how you feel this is going to go for the next 2 to 3 years and how you're going to make this happen. The other thing we want to see is that you have some collateral that we can attach as far as leverage is concerned. We want to see that your credit's okay, that you made some payments in the past. But mostly we're willing to bend over backwards to give that entrepreneur, that startup, the benefit of the doubt that if it's in the industry that we believe that you can actually do what you say you're going to do in your projections, then we will make that loan.
What percentage of your loans are to startups?
Probably about 20%.
20%?
Right.
Interesting.
Right. And what we require, I'm sorry, George, what we require on the startup for the entrepreneur is usually 15 to 20%, whereas if you're a professional startup, such as a dentist or medical practice or whatnot, it's 10%, because that's an industry that really thrives, and the risk factor is a lot less for us.
What about personal guarantees?
Personal guarantees, yes. We will require a personal guarantee on each loan for 20% or over ownership. Okay? Now, in some states, it's community state.
Excuse me, I didn't follow that.
Okay.
What's that mean? For 20% or more ownership, what's that mean?
Well, in other words, if you're acquiring the business and you're going to go in with 20% or more ownership,
then you require a personal guarantee.
Then we require a personal guarantee. That's correct. Now, in a community state such as California and the other states, the spouse or the significant other is going to either agree to that or sign a declaration that they're not liable for that 20%.
And you accept that?
Yes. Yeah. Even though we're not, it's a community state.
How about what percentage of yours have personal guarantees?
Of the deals that I see, the majority have personal guarantees if it's in a fairly young entrepreneurial startup company. They want to see, and it's not the banks or the funding sources don't want to see as much they're not going to go against the assets behind that personal guarantee. It's much more of the moral backing of the entrepreneur. If you believe enough in the business plan that you're presenting to the funding source, then they want to see that in terms of that moral backing. It's difficult to get away from the personal guarantee if you don't have strong venture capital or strong institutional equity players behind you.
I might say, as a member of a board of directors of a bank, we go after the assets.
You're right, but
you got a nice car.
But meaning that because you can, they're more likely to work a little bit harder to try to repay that money.
Yeah.
You're not.
Do you have a personal guarantee?
We have never gotten a personal guarantee. In fact, that's why we exist. The First Dominion Fund was founded in '85, and it was actually the capital was contributed by venture capital partners themselves. And it was because there was perceived to be a gap in the market. The entrepreneurs, the venture investors looked at established firms that were getting, at that point, leases to purchase equipment. And they wanted that for their startups to extend their capital. And every time they tried to get it, it either had covenants which made it not useful or had personal guarantees. And so the entire reason why venture lending and leasing started was to provide capital that did not have guarantees. So we have never gotten a personal guarantee in any investment since I've been there. We generally do not have any financial covenants either. And so another way to think of what we do more generally, even outside of venture, is we look to be in between debt and equity. And the way we think of it is there are a lot of companies that have a lot of promise and have established themselves, so they've built some enterprise value, or they have assets that are worthwhile, yet they can't get traditional bank debt, or they don't want traditional bank debt because of guarantees and covenants. So their other option is equity, and they default to equity, which is very costly. So we attempt to find opportunities where there's some value to support a loan, but something that a traditional lender wouldn't approach, and where, because of that value, it shouldn't be equity either, and it's a win-win for both of us.
Now, I want to encourage people to ask questions, but while you're gathering your thoughts, I wanted to ask one thing that struck me as we're talking about entrepreneurial finance. One of the things about most startups is that for a while, they don't make any profit. And one of the advantages of debt is that the interest is tax deductible. But that advantage is moot when the company's not paying taxes,
Right.
Which is why a lot of entrepreneurial debt really comes, in my experience, in the form of preferred stock, with a dividend,
Right.
a dividend similar to an interest payment. Why would an entrepreneur want to take debt instead of preferred stock?
Well, it's the equity cost of what we do is less. So if we, and you had asked about terms, so now I can talk about terms a bit. Our standard structure would be, and it roughly is around a 3-year repayment of a loan with an all-in return on the loan, because there are fees in addition to the interest rate, that is from 12 to 18%. And then on top of that, there's equity ownership of 5 to 15%. And the equity ownership is a percent of what we invest. It's called warrant coverage. So if it's $1 million investment, 5%, $50,000 worth of warrants to buy preferred stock, maybe $150,000. So for an entrepreneur and the venture investors themselves, to the extent it's venture backed, they're saying for $1 from us, they'll have to pay back a certain bit more in interest, and they'll have to give up some equity, or they'll have to give up $1's worth of equity. And if you do the math, we're much less dilutive from an equity perspective.
Sure.
Now, back to the repayment, for early stage companies, it's interesting, but a way to explain it is, entrepreneurs shouldn't be and wouldn't be starting companies, and people wouldn't be investing if you didn't expect the company to be more valuable in the future. And so, in essence, you're saying we're going to take money we're going to repay out of future rounds of financing, but we're going to repay that money with money we've raised at a higher valuation. And the rate of return an equity investor wants to invest, if you do the math, is about 45% a year or more. And in our case, it's 20 to 25% a year. So there's a benefit for our investment Granted, it'll be repaid in the future, perhaps before the company's cash flow positive for an early stage company, but it'll be repaid with cheaper capital. And so when the math is done, it's much more attractive. Even if you have access to funds, as venture firms do these days, it diversifies the risk and it leads to better outcomes. Now, for later stage, George, it's different. When we invest in a later stage company, they may be at or near profitability, and there they can repay us through profits in the company. And at that point, it's a different equation.
Gotcha. Okay. Yes.
So how much, when you're going out, someone's raising funds, are you on top of equity, or are you sort of blended? So if I'm going out and raising $5 million, are you coming in at 2.5 of that, or are you coming in at $5 million plus 2?
For an early stage company, we come in at or shortly after a round of financing, and usually it's to complement the financing. What people do is they raise enough money to meet the business plan for the next 12 months. Maybe that's $5 million. And then they look to supplement that in case they have a setback and need an extra couple of months of runway. And $2 million on $5 million might be common. It's uncommon to make it equal at that point, because at that point the company's not profitable. It'd be over-leveraging it. And in that case, we'd have a concern because we are not similar to equity in that we do not necessarily invest in later rounds. So there'd be a misalignment of interests if we were investing as much as equity investors.
You're in front of equity.
We are in front of equity. Everything we do is a secured loan. It's either secured by assets or it's secured by enterprise value. Now, I haven't talked about types of loans because we'll loan across the spectrum. It can be equipment, can be AR, can be just based on enterprise value, which is called growth capital quite often. It can be used for any corporate purpose. But it's always a loan, and in fact, in virtually every case, we're the most senior lenders in the company. The only other loans are sometimes from banks for AR. So we are in first position, and that's part of our benefit. If things don't work out, whatever's left over, we get.
What's the average size of loans?
Probably looking average size, probably about 800,000. Now the Bay Area is different, right? And we're across the nation. I would probably say 800,000 in that range. The 7A loan can go up to $2 million for a business acquisition startup.
And I'm sorry to follow up. You said you mentioned collateral, and you also mentioned personal guarantees.
Correct.
Oh.
We cannot decline a loan based on collateral. So if there isn't sufficient collateral there, we still have to underwrite it and make the loan if we feel that it's a viable loan. Absolutely.
How do you price the warrants? Based on the last round, fair market?
Almost always it's based on the last round. So in our case, because we can vary the warrant coverage, we can take the price to some extent as a given and vary the warrant coverage based on whether we think the value was fair, whether it's increased since then or changed in some way. And that just makes it simple from a documentation perspective.
What is the sensitivity also then on the interest rate that you charge versus coverage? So rather than 18%, if you charge 6%, how much more warrant coverage that you cover?
We will make those trade-offs. In fact, we like those trade-offs because equity is what gives us the return. I can't answer it specifically, though, because it depends on what the equity upside is. So, for example, we invested in one company that had a $12 million in our last fund that had a $12 million post-valuation as a Series A. It was a company by the name of Qterra. And we had very low warrant coverage, and it went on to be purchased by Nortel very significantly. Similarly, we invested in another company that was fortunate by the name of Google, and our warrant coverage was very low because it was a very successful company at the time we invested. So in those cases, and in fact with Google, we had a trade-off of interest rate for warrant coverage, but it was specific to the opportunity.
You invested in Google?
Yes.
At this scale?
Yes.
It must have been a while ago.
In 2001, at the end of 2001, they were just turning profitable.
This is the previous fund.
Correct,
Dominion,
yes.
Not the current 300.
Not Leader, no,
Yeah,
previously.
okay.
At the end of 2001,
Yeah.
in the fourth quarter, they were just turning profitable, and they were growing quickly, and they needed more servers. And so they did a $15 million lease financing, was structured as a lease to purchase more servers. Interestingly enough, they were turning profitable. They had cash in the bank. They never spent it. But they used our financing as opposed to going to a bank or somewhere else because we don't have covenants, we don't have personal guarantees, and the investors knew us. And from their perspective, it wasn't worth risking the company over taking a partnership with someone that, if they had a hiccup, would be an issue. And they just wanted to have a fair bit of dry powder in case they saw acquisitions. So, in a lot of successful cases, the companies don't have to have the financing. It's just useful to have it.
Yes.
So you said that you invest in companies that are already venture backed. And as an entrepreneur, if, for example, I would like to go and raise venture financing or venture lending, how do I go and convince the venture capitalists that I don't want to dilute my equity and that I would like to take venture lending? Would they go for that? And if they see an upside on the company, why would they let you guys come in? Because obviously at the board of directors level, they eventually approve whether this can be done or not.
Right. So from the perspective of how you arrange it, usually equity investors, entrepreneurs, and ourselves prefer it that equity can fully fund the plan, right? So you have a business plan for 12 months, you raise a certain amount of financing. If it's a very asset-intensive business, though, then that is one where quite often we will begin speaking with the company in parallel to equity discussions because the debt is an integral portion of the plan. And you can't actually, the equity investors themselves and the entrepreneurs say, we can't consider the equity investment unless we know that we can have debt. So in those cases, you need to arrange it together. But in most cases, the equity will cover 12 months of operations, say whatever your milestones are, how much time you need to achieve your milestones, and debt is a supplement to that.
Just a follow-up on that. So do you normally have entrepreneurs coming up to you and asking for lending, or is it more the venture capitalists that they're trying to bring you into?
Much more the venture capitalists. Much more the venture capitalists. Now to your second question, why would the VCs welcome this? One way to answer that is, well, why do they welcome other investors, right? I mean, there are a lot of reasons. They want expertise, but they also want to diversify in what they do, and they want to have more dry powder for later rounds. So some of the same factors come into play, and it will also increase their return on an individual investment. Those are all early stage. The dynamic in a later stage opportunity is very different. At that point, we are often substituting for equity in place of what the venture investors would put in themselves. And at that point, it's much more parallel interest because they don't want to put more money into a company that's already established, where they already have their investor syndicate together. And either they dilute management when they do that, or they're putting more money in for no additional ownership. In that case, there is no question about it. In that case, if it's appropriate, debt is a very good solution.
With respect to the clients that you're taking on, which of those clients, or could you describe the characteristics of your clients that have been successful in getting senior debt and subordinated? And which of the clients do you sort of not take on because they're not ready? I mean, in terms of industry, their growth prospects, margins.
That's a very hard question to answer because each transaction is so unique. But I think if I look at what are the characteristics of successful companies, and those would be the ones where the entrepreneurial group has done an incredible amount of research. We know the merits of Excel spreadsheets, that it always looks hockey stick, but it's those companies or it's those entrepreneurs that understand what they should be doing if there's a downside, who have addressed not only the opportunities that are out there, but what if there's a downside in terms of the industry or competitors coming in, who understand how to deal with the challenges and address those in that plan. The most successful companies are also those that, as Patrick has said, has a little bit of dry powder, who say, well, I really can execute this plan with $5 million, but I'm going to raise $7 million because I want to make sure, just in case I'm a quarter delayed in meeting some milestones, or if the market doesn't take off as fast as I can, or if I have to pay more for some expertise, I've got the money to do it. So that they plan for downsides, they plan for the eventualities. And that's what the banks are looking for. Especially on an entrepreneur, you don't have that much of a track record, and so to the extent that you can pull an advisory board that brings you some more track record, some people out of the industry, or some people that have been through companies in your cycles before, if you don't have venture capital backing, that's also another plus.
What size range TEV or characteristics of businesses do not require personal guarantees with the loans? I mean, they have to be extremely large. And then secondly, what are the debt to equity levels that you look at in I know it varied by industry and whatnot, but generally speaking, for small business acquisition.
Do you want to start?
Well, why don't I start, and then Greg can chime in as well. Right. Because I see a wide variety of sizes of transactions, and frankly, if you're not venture backed, it's probably easier to raise financing for an acquisition as opposed to a startup. And the reason for that is you've got some proven historical cash flows. They may not be pretty, but at least you've got some cash flows to start with. You've got a history to start with. In terms of the second half of your question about what are the ratios of acquisition debt, how much debt can you raise if you're buying a company? There's kind of some rules of thumb out there. Right now is a tremendous amount of money in the commercial banking, in all the banking areas, asset-based as well as commercial banking, looking to back acquisition financing. Not too long ago, the maximum amount of debt to cash flow was 2 to 1. Now you can see deals done 4 to 1 or higher in terms of the amount of debt you can raise against the cash flow. Now, getting to those higher numbers is normally larger transactions, normally acquisition purchase price $10 million and up. When you get $10 million and below, it's a more conservative view because a company is normally not as broad-based. It may not be in as many markets. It may not have as much bandwidth if something bad happens. Or is that kind of what you're seeing, Greg?
Yeah, I mean, we're a little different because we underwrite on cash flow. Okay, so obviously a startup doesn't have cash flow. But what we'll do is we'll take their projections. We have another company come in that does evaluation. Is this real? For the demographics and the type of industry, can this really occur? What they've drawn out here in their projections. And a lot of the time it's true. And we'll go by that. We might ask for a little more injection, in other words, down payment, depending on the risk factor. But normally we'll go by the projections. We'll go through our underwriting guidelines with the 10 or 20% down in that range. Yes, we'll ask for a personal guarantee if they're 20% or more owner. Our underwriting, as opposed to venture capital, is far simpler. I mean, it's an underwriting matrix, if you will, that you fit in this criteria. We'll bend the rules because we're a preferred lender status. We don't really deal with the SBA until the very end that we ask them to guarantee our loan based on how we've underwritten it. So does that answer your question about business acquisitions are up to $2 million, and let's say we need an injection of 10% by the borrower. Okay, so they're putting in $200,000. We'll make a loan at 1.8, right? And we'll give you working capital to get you close to 100% financing.
And just with the personal guarantees, at what size range do you start seeing those personal guarantees drop off and it becomes more institutional money? You feel it's more institutionalized.
I usually see it for loans of $10 million and over, and some of that is also seasoning of the company.
Does everybody know what a personal guarantee is? Basically, they're going to go after everything. They're going to go after everything. So.
Except your house in Florida. Yeah.
So again, more to Jeanne and Greg. When it comes to, again, more the acquisition side, such as a search funder, can you talk a little bit about what you expect or are okay with on the etiquette of these individual search funders coming and asking you in advance before it's really getting close, but you're looking at some targets, what types of ranges that you'd be willing to, what types of loan amounts you'd go to, and what your sense is for those deals?
I've probably worked with 35 or 40 search funders over the past number of years who are looking at companies and call and say, it's this industry, what do you see going on in this particular industry? What are the trends that are out there in the market? Because I see so many deals, and so I can kind of get a feel, because the market changes quite dramatically. I was talking with Greg earlier, CIT was not a big cash flow lender for a number of years. They were only doing asset-based financing. And now CIT is a huge cash flow lender. They're backing many of the private equity leveraged buyout transactions going on here, which are all cash flow lending. So banks come into and out of the market quite frequently. And so it's hard for someone outside to understand what's going on in the market.
So you're fine to get a phone call that's, hey.
Only if, when you really start to do the deal, then you hire me because I can get you a better deal.
And your loan amount starts? Where are you looking at?
I really work with loans $10 million and above.
Right. So that's a major difference.
That is a big difference. Otherwise, if it's a smaller loan, I'll say, hey, I heard so-and-so is pretty active in that segment of the market type of thing.
Right.
Sorry. Go ahead.
The rates? Okay. On a business acquisition, we deal with prime. Prime is it, and right now it's at 8.25, and then there's what's called the spread or the margin over that, and that we can play with and negotiate because depending on the industry, the risk factor, the collateral, the reserves, we can usually reduce the margin to about 1.5 on a business acquisition and usually below 1 on a real estate transaction. Okay, we'll use on a real estate transaction, it's what's called the 5-year swap rate, the treasury, plus a margin, okay? But the business acquisition side, it's prime plus a margin.
You must do, in addition to that, some more higher risk lending or with bigger spreads, don't you? Or is 1.5 kind of your maximum spread?
Oh, no. We'll increase our spreads.
How high does it go?
How high do you want it?
Take the 3% of your book that's the most risky.
3 basis points.
300%, or 3 basis points, yeah. 3% over prime.
Are there fees as well?
Well, there's a packaging fee of $1,500, and you're going to pay fees through title and escrow to close the loan. If there's an appraisal done on the commercial building, it's roughly around $35,000 to $5,000. So there's fees like that can add up to, let's say, $10 million, right? $10,000. We'll add that into the loan, so you pay that over time.
Does the SBA on cash flow deals, does it have a maximum rate that you can charge?
George, that's a good question. I know what CIT will go up to, and as far as usury is concerned, no, we'll max out at a certain point. But that's usually what's the spread. The 3 basis point spread is as high as we'll go. Wow. And we'll use prime or the 5-year swap rate. But I wanted to answer your question on just one aspect. Again, we're cash flow lenders, and your question again was
the protocol for
right.
The process.
If somebody calls and says, I want to open up a pizza place, and it's in Oakland, what do you think? And I have these projections. Is that kind of what you meant?
Yeah, or more like I want to buy this,
right.
paper distributor or whatever
right.
it is.
I do a very simple calculation. I ask them what their projections are, right? For maybe 2 years, have you thought about it? What's your business plan? And all I do is calculate the debt service on the loan. So in other words, taking the rate, the term of the loan, I'll calculate on my HP what it is monthly and what it is annually. And then we want about a 1.20 coverage above break even, okay? That's dividing the cash flow into the debt service, okay? So we're looking at roughly 20% over break even on the debt service. So when I ask you about your projections and you give me a figure and I'm thinking it's a pizza place over here, is that plausible? And that's how I talk to my clients on the phone and say, it sounds great. I think that makes sense, or it's not going to happen. I really don't see it happening.
And that doesn't change depending on how many tangible assets the business has versus.
No, not for us. We're cash flow lenders. We're really looking at covering the debt service or a little above that. Okay.
Yeah.
So if I'm a startup and I want to, and it doesn't cost all that much money to start a little company out, I don't want to necessarily raise venture debt yet because I've got to go raise equity capital, if you can call it. One thought is I'm going to go raise $500K of money from a commercial bank. what does your diligence process look like to make sure that, if I'm a startup specifically, it's not even a pizza place where you can kind of get your head around what that business looks like. What is your diligence process like for backing a loan like that?
Great question. We will have a company come in who will evaluate based on projections and demographics and the type of industry that you're in and the risk factor. I mean, there's many calculations, right? And they will determine whether it's plausible or not that you're actually going to be able to do that based on your projections. And they will give it a value. They will say, you know what, this business is really worth $500,000, not the $8 that the client is thinking of. So can they put up more money, or can we reduce the purchase price? And that goes on a lot. There's what's known as business brokers out there. They're buying and selling businesses all the time. A lot of them will come in high for their client. We'll do an evaluation on that business. We'll ask the broker to reduce the purchase price or come in with more money.
Yes.
For each of you, what's the average time between the first time I talked to you and money in the bank?
The average time is about 6 to 8 weeks. The shortest is we closed one that was 6 days. And the longest is generally not more than 2.5 months. And it's driven, frankly, by the borrower's counsel as to how long it takes.
I thought he was going to say the longest is never. Hasn't closed yet.
Of those that closed.
For our clients, the longer, it's usually more in the 2 to 3 month period of time, because we're talking to a larger number of lenders as part of the process.
It's a loaded question because it depends on how well prepared the client is. So in evaluating the company and whatnot, if they have all their ducks lined up, it's 30 days. It's very streamlined now. But if they don't, it usually runs around 60 days.
Greg, are there any legal businesses that the SBA will not support? Liquor store, check cashing, things like that. Is there?
No, and you said the magic word legal. Yes. Prohibited would be the non-legal. So anything legal, we'll let out.
Too late.
Now, say you give a personal guarantee and you also have a few partnerships or companies, maybe you might be the sole proprietor. Will they be going after that as well? Say you have like an LLC.
Heck yes. What are you thinking?
But that partnership or that other business is going to pay off the loan for the business that's going bad, right? I mean, it's not like we go immediately after all your assets. We do workouts. We try to help everybody get back on board as best we can. And, if there's just no option left and there's no way to recover that debt, then that's when they start. And it takes quite a while to do that.
One of the most egregious, I don't know how my fellow panelists would feel about this, but one of the most egregious things that banks experience is that in the United States we have a state called Florida that will allow you to buy a residence like Mar-a-Lago, which Donald Trump did, and then take as much money as you can and put it in that residence and then go bankrupt. And you can't take back a residence even if it's a little bigger house than you might need. And that's when you hear bankers utter an expletive, like, what the heck is going on here? And that's why they have covenants. And the right of offset, the right of offset is a perfectly reasonable thing, particularly when most borrowers know they're going bankrupt before the lender. And so they want to drain the bank account, but if the lender gets word of it, particularly that somebody's been saying they're going to go bankrupt, or they realize that there's some litigation against them that could do it, the bank likes to be able to be in a position that will protect the bank from the ridiculous notion that all of a sudden an asset that the bank already had at the bank is going down the toilet over here when it could be used to pay part of the loan. I don't know of very many banks that exercise the right of offset casually. I mean, because if you exercise it casually, usually the bank gets sued for causing the failure. Isn't that?
Yeah, that's correct. It's very rare. I mean, and it's because what we do, and same with the banks, is a repeat game. You're working with the same people. And so it's rare to exercise that right because it torpedoes the relationship. And it's really only happened in, as I said, 2001, 2002, recent. And usually it is when the bank believes they've been misled. So if you were to ask the other side, which you have to do fairly, what they would say is, look, this is because we've not been told what's going on, right? If we'd been told what was going on, it's when we've lost confidence. And it's not just lost confidence, we've been actively misled as to what the situation is. So it's certainly a concern when you've had that happen to you, but there's two sides to the coin, if you will.
I want to know what the kind of overall default rates that you see are, and whether you fund first-time entrepreneurs who don't have a track record, whether the default rates are higher amongst that population.
So we will fund first-time entrepreneurs. We've not observed any difference in default rates between first-time entrepreneurs and repeat entrepreneurs, and that's big controversy as to which are better or worse. We really look at how experienced they are and how suitable the background is. And being a successful entrepreneur is a plus, but it's not the only plus that's there. As for default rates, we are risk capital. We have approximately, we expect, and historically, about a quarter of the companies default, and they do not repay the entire loan. But because we are paid down over time, at least the average repayment is fairly high on that. So you look at something that ends up being in single digits loss rate for what we do, depending on the vintage and the overall venture market. A 99 vintage, which was our last fund, would have a very high rate of default, but nonetheless it's still single digits of capital lost at the end of the day.
Any of our other panelists comment on that?
I can't tell you what the SBA, you mean as far as the SBA default rate? I don't know that figure, but I can tell you that there's certain segments of the market that we just don't really particularly like to lend in because their default rates are high, and that would be a startup restaurant in an unknown area with no management experience, and they worked at a gas station, but they want to open up a restaurant. So, that's the kind of thing you want to steer away from, and because those default rates are high.
In terms of it's too high, what counts too high?
You mean by industry or overall? Well, I would say a startup restaurant in that industry is probably, you're looking at about 60%. Yeah, it's pretty high.
But those aren't funded by you. You don't experience 60% default.
No. I'm just saying
of the loans that you fund, what is your historical default rate? 1.5%?
All of CIT, yeah, you're right. It's probably about 1 to 1.5%.
Yeah. I might say that in a non-intuitive way, I don't know whether Greg would comment on this, but I know some bankers don't like SBA loans because they figure that there are two kinds of loans, good ones and bad ones. And if you have a good one, it's nice to own it all because it's a good loan, right? Good loans are wonderful. If you have a bad one, it's nice to own none of it. Now, if you have a loan that's a little bit of both, with an SBA loan, you fund a $10 million or say a $2 million loan, the government takes 3/4 of the principal, but the government doesn't take any loss until you've lost your whole 25%, right?
That's correct.
And so you wind up taking sort of all the risk for 25% of the return.
Right. But plus
real tough to figure that one out. So.
And George, we have their injection on top of that. So you're talking really about 15%.
Yeah.
Is kind of the spread there. So.
Yeah. So SBA loans look like a slam dunk in favor of the bank. They're guaranteed 75%, but it's only after you lose 25. So it's a little bit more complicated than you think, and that's why SBA loans very often have a reasonably high threshold for quality. Ladies and gentlemen, if there are no more questions, I would thank our panelists very much for being here. We appreciate it.